Hopefully, you can see my screen. Is everybody able to see my PowerPoint slides?
Yes.
Yes.
Fantastic. All right. So again, this is a published research paper that I did with a couple colleagues, couple friends. My colleague Felipe Raimundo is here at the University of Arkansas with me, and my co-author Chung Do is at the University of Nevada, Reno. And so you can see, sounds like somebody's microphone is on. They might want to shut it off. It might make things a little bit better. But so I'm going to talk about principal components and factor analysis use in accounting research. Basically, the idea behind this study is several years ago now, one of our top researchers, an editor at a journal, reached out to all accounting researchers across the globe and said, hey, we're thinking about doing an issue in the Journal of Financial Research on methods. Is anybody interested in writing a methods piece? And I sent that editor an email saying, listen, I do a bunch of reviews. And for those of you that are not in academics, how a review works is somebody creates a research study and they submit it for publication. And when they submit it for publication, some reviewers look at it to see whether or not it's good or not, essentially. And I do a lot of those reviews for a lot of our accounting journals, especially a lot of the top journals. And I told this editor that it seems to me that a lot of people who do research in accounting don't seem to understand the difference between a principal component analysis, PCA, and factor analysis, especially an exploratory factor analysis, EFA. And so I proposed to him that a paper on this needs to be written. And he said that that would be a good idea and that I should do it. And my response to him is, but I don't want to do it. Like, I just want somebody else to do it. But he suggested that nobody else on earth would want to do this paper. And so I decided to do this paper. And so that's the genesis of this project is I do a lot of reading of papers. And when I do the reading of papers, sometimes it seems to me that studies don't really know how to do principal components and factor analysis. And so that's what we're going to be talking about today. So the key takeaways from my discussion today are going to be probably fourfold. The first thing is we're going to spend some time discussing the differences between a principal components analysis and exploratory factor analysis, both in theory and application. Further, we're going to talk about how much these methods are used in accounting research specifically. I'm not going to spend a ton of time, but if you are able to access our paper, the paper is available. You'll see that there is a programming guide in both SAS and Stata, two very common programming languages that are used to do statistics in accounting research. And our paper provides detailed code to do that. Tonight is not really a coding session. I'm just going to be talking about the analyses a little bit. And then finally, as a kind of an old researcher, I'm going to talk about some recommendations, observations, notes, and some citations to the literature that you might be interested in. So that's essentially what I'm planning to do. I'm noting that a lot of people are writing in the chat, which is great. I'm not going to be checking the chat as I present. And so if anybody has a question of me or needs me to do something differently, if you could unmute yourself and ask the question or whatever. I have trouble monitoring a chat while presenting on Zoom. And so again, if you have a question for me, feel free to unmute yourself and ask the question. All right. So moving forward, what in the world is PCA versus factor analysis? Now, both of these things are statistical techniques that are used to represent a set of observed variables in terms of smaller number of variables. So basically the idea is if you have 10 variables, you might do a PCA to try to get that down to 2 or 1 variables. Alternatively, you have like 10 measurements, like you ask 10 questions. And if you're curious, like how connected are those 10 questions, an exploratory factor analysis might be interesting to boil those 10 questions down to in their factors. those are kind of the ideas behind these things. And while they're similar, they have different purposes and different uses. And often, as I said, researchers struggle with using them properly. And so that's kind of what today's session is going to be about. So let's first talk about PCA because it's probably the easiest to understand. Principal components analysis is essentially taking data that has higher dimensions. So you can see here in this picture here, I'm gonna see if I can't make myself able to write on stuff here. And I'm gonna grab a pen if I can find my pen here. Oh, there it is. All right. And so you can see here that this data is in 3 dimensions. And oftentimes as researchers, we want to take the dimensions and we want to boil it down into simpler dimensions, for example, into 2 dimensions here, principal component 2 and principal component 1. And so one way of thinking about what a principal component analysis is it takes data from higher dimensions and it boils it down into lower dimensions. Because while this data can be hard to understand, look at those 3 dimensions. If you look at this data, it looks like the green dots and the purple dots have a pretty interesting pattern, and so do the yellow dots and the blue dots when we boil them down, right? And so the idea is if you have data and you need to break it down into lower dimension data, principal components is a good way to do that. And so the way that I tend to think about it, let's say you have a bunch of different measures and they all are in theory measuring the same thing. Well, in theory, there's one component and you have a bunch of different measures on that component. That's the purpose of a principal component analysis is to take higher order of data and bring it down to one underlying principal component or 2 or 3, depending on what the data shows. I'll talk about that later. But that's the idea behind PCA. In addition, sometimes the data is in a pattern in which it makes it harder to explain. And so one thing that we might want to do is orthogonalize the data in such that if we orthogonalize it such that the data is upon 2 different axes that are easier to understand. And so if we look at this point, for example, here, it's hard to understand the point when we look at here, but here you can see it's this far in the PCA1 component axis and that far in the PCA2 component. And so orthogonalization can help us understand the data points relative to each other better when we simplify the data using a PCA. So the way that you tend to think about it from a textbook perspective is I have a bunch of different variables. These are my different variables, and I'm trying to boil these different variables down to different components, principal components 1 and principal component 2. Okay. Now remember, these variables can all be related to each other and related to both component 1 and component 2. And it's okay if variable 1 is positively related with component 1 and negatively related with component 2. That's okay. That just tells us how the data works and how it fits to get an idea of what my different principal components are. That's the idea behind it. Now, this might not work very well for tonight. You guys are from Indonesia largely, and it turns out this is an example in the Western United States. And so as you can see in 2014, this author likened PCA into exploring a town in the Western United States. And I guess the only thing that you need to know about the Western United States is it is a vast area where it's largely wide open and the towns tend to be pretty spread out. And so if you think about a town that is wide open and spread out, he likens using PCA as driving down the main road, the main road of that town, whatever that main road in Jakarta might be. And then when you reach another big road, taking a right or taking a left, and then exploring the town based on that main road. That's essentially what an orthogonalized PCA is doing. It's basically exploring the town along 2 dimensions or 3 dimensions, but all of them happen to be perpendicular to each other. Okay, it's a pretty nice analogy if you've ever been to the Western United States. But given what I know about Indonesia and how hilly and mountainous it is, my guess is there's probably not too many roads that are exactly square to each other. It's probably pretty windy. But what do I know? I've never been there before, so I could be wrong. All right. Now, what is factor analysis? As I've mentioned before, factor analysis is something it's similar but different. Factor analysis, imagine you have a bunch of different variables, right? And these variables are likely related to some underlying factors. Okay, there's something underlying, something especially difficult to measure that the variables can be used to measure. And so, this is the common graph that you see where you have factor A and factor B, and they're related to variables 1 through 4, 5 through 8. But it's probably more like this, where you've got a factor 1 and factor 2, and all of the variables are related. They're correlated, especially in social science. All of these variables are probably correlated both to factor 1 and factor 2, but there's higher correlations among maybe variables 1 through 3 on factor 1, and lower correlations on variables 4 and 5 on factor 1, but higher correlations for variables 4 and 5 on factor 2, for example. And so those are probably what you're more likely to see in social science. And so I went this evening and pulled an example for you about a common factor analysis. So if you've ever read about personality theory, in theory, there are 5 type of personality traits that these dimensions, these factors, these 5 dimension that most people vary upon when they look at their personalities. How neurotic they are, how extroverted they are, how open they are, how agreeable they are, and how conscientious they are. Okay, those are just 5 different types of personality traits. And so if we went and we looked at these questions, does he or she talk a lot? Does he or she find it easy to approach others? Does he or she know how to captivate people? Does he or she make friends easily? And is he or she the life of the party? If you looked at those questions, all of those things are likely measuring extroversion. Now, extroversion itself is a really hard thing to measure, right? Whether or not a person is extroverted. But if you asked about these traits, and these are all traits associated with a person, you would say, oh, that person is probably pretty high on extroversion. This idea is that these would load into one factor, and that factor we would call extroversion. We name it extroversion, essentially, right? Now, the problem is some of these things would, of course, also correlate with openness and neuroticism. A person that is very neurotic is probably not a person that would find it easy to approach others. And so there's going to be correlations amongst these variables with all the other factors as well. And this is kind of the problem with doing social science, is nothing is very clean when it comes to measuring different variables and different factors like that. Okay, and so this is an example of what a exploratory factor analysis might do. You might ask 30 or 35 questions about a person, about their traits, about what they like to do, what they do, and then we would basically explore how those questions evolve into 5 different dimensions, or 6 or 8 or 3, or whatever the data tells you about people's personalities. As I note here below, Srinavisti and John, 1999, essentially found that there are 5 dimensions on which personalities exist based on their analysis, their research. And so that's an example of factor analysis. I'm going to give one later in the class related in this session, not class, sorry, in this workshop related to accounting and information environment. But this is kind of the theory and the way that it works. So in our paper, what we've talked about is readability versus textual disclosure components. Okay. And so this is the way that we talk about, I do, if you've read any of my research, you know, I tend to do textual analysis type research, especially on conference calls. And so there's a lot of research that looks at how to analyze text. And so one common measure is readability, and how easy is it to read this report, okay? Usually a report written in English. Now, it turns out there are a lot of measures using readability: Flesch-Kincaid, Gunning Fogg, Smog, Licks, Ricks, and ARI. Okay, I don't even know what 3 of these are, but there's a lot of measures to measure how readable a disclosure is. Now, readability is one thing. Okay, and it's one thing that I'm trying to measure, but there's a lot of different measures here. And so what analysis would I do if I wanted to make all of these things one? I would probably do a principal components, because there's one underlying principle here. How readable is something? Whereas I'm not trying to explore and see, okay, what is the difference between gunning fog and smog and flush Kincaid? I am trying to say readability is my thing. How can I measure readability using different measures, but really boil it down to one principal thing? This is an example of principal components, a good example when you might want to use principal components. Whereas, let's say that you're trying to measure different dimensions of a text. Let's say you're trying to look about how much they disclose, or how comparable the disclosures are, or how complex those disclosures are, or how much they use boilerplate language. Those are all different constructs. Complexity is very different than the quantity, the amount. Complexity is very different than how much you copied, boilerplate, how much you copied other stuff, either myself in the past or somebody else's disclosure, right? Boilerplate. And so I wouldn't want to do a PCA on this. I wouldn't want to take all of these wonderful individual traits of a disclosure and put it into one thing. That would be awful, right? That would basically reduce the richness of disclosures. But instead, I might have multiple measures of quantity of disclosure, right? The length of the thing, the number of sentences, the file size. There's a lot of different measures that measures these things. And I might have various measures of complexity, right? How many different segments they have. How much, what are some other complexity measures? How much bid-ask spread differs on analyst forecast, all sorts of things related to complexity. I wouldn't want to try to make all of these things the same, but rather I might have all of these measures, and I might do an exploratory factor analysis, and I would expect dimensions that were associated with the quantity to have their own factor, dimensions that are associated with complexity to have their own factor. And so that's the difference between doing a principal components. I have one thing with a lot of different measures, and I have a lot of different factors and different just different elements associated with disclosures. And I want to see, what is the data based on all these different measures? What does the data tell me? I'm an exploratory factorness. What does the data tell me how many factors I have here? And how can I name those factors based on the loadings of the individual things, right? That's what exploratory factor analysis is for. So, some key takeaways. I have some statistics later on this stuff, but we find it turns out that both PCA and factor analysis are used across all different elements, all different types of accounting research. Specifically, we find that 32% of studies examined implement one of these procedures to obtain a critical measure, in this case, a variable of interest in their study, and 12% use it as the dependent variable. The factor analysis, or the PCA, is the dependent variable, arguably the most important variable in an analysis in a regression, right? And so clearly, if over 10% of our studies have the dependent variable using CFA, not CFA generally, but exploratory factor analysis, or PCA, then this is probably something we should know how to do, right? If over one third of our studies in accounting use a variable of interest, their variable of interest is a product of a PCA or factor analysis, we should probably know how to do this. And so that's the idea behind this project. I told you I review a lot of papers. I'd see this done and I'd be like, what are they doing? Why are they doing it this way? Or alternatively, they use it right, but I don't know how good the use is. And so we're going to talk a little bit about the disclosures associated with this. We also find that disclosure choices, as I said, are not well disclosed. And so even if you're doing a PCA right, I don't know it. As a reviewer or as a reader of your paper, I can't tell, because you don't produce enough statistics. You don't produce a table or an appendix or something to show me that you're doing it right. And then the accounting studies probably implement it without a full understanding of when you should orthogonalize. If you orthogonalize what is the best way to orthogonalize your data, that sort of stuff. And so we're going to talk about that tonight. Those are the key takeaways. One of the things that you should take away from reading our study, if you did read it, and I hope you do, I hope you either will read it or have read it, is it turns out that the different choices that you make can affect the results. We showed that the results change based on the decisions that you make, which I guess shouldn't be surprising. But again, if you're doing research and you want to do it right, what this says is if you make incorrect choices in modeling, it will result in different results, which probably isn't a good thing for the statistical conclusion validity of your study. And then, studies that implement alternative but justifiable decide specifications may arrive at different conclusions. And so if one study uses a justified method of X and another study uses also a justified measure of Y, we might come up with different conclusions. And we as a academic body should probably understand more fully the implications of that. That's kind of the takeaway from our thing. So, we recommend in our study that studies that use PCA or FA should be more diligent about showing that their results are not conditional on the design choices that they made, and they should disclose their design choices more freely. One of the things that we point out in our table, in the data analysis table that we have, is very few studies report the statistics associated with use of PCA or factor analysis in their study. So we're going to talk about this a little bit more later, but basically the choice between PCA and FA should depend on the nature of the variables, on what you're trying to do here. If the observed variables are suspected to be linked together by some latent construct, FA is the answer. Use factor analysis, probably exploratory factor analysis. If the goal is simply to reduce the data set into a smaller number of factors, then principal components analysis should likely be used instead. Now, researchers have to be careful. It turns out the structure of correlations, the correlation structure of the different variables that you're using. So again, I said, let's say you have 35 questions or 35 variables that you're using. How those things are correlated with each other will affect the outcomes of PCA and especially factor analysis. And researchers have to be careful and should be wary of any rotations that they make, because the rotations that they make affect the interpretations of the tests. I'm going to talk a little bit more about this. Again, we're still on takeaways. We'll get to the more specific stuff. But I just wanted to start off the session with talking about what the key takeaways, in case after 20 minutes you're done with listening to me and you don't really want to pay attention to the details afterwards. But that's the idea behind it. These are the key takeaways. Finally, we recommend that studies tabulate stuff. We want to see more disclosures. Give us the eigenvalues. Give us the factor loadings. Give us the data associated with it so we can judge whether or not you're doing a good job of using a principal component analysis, something like that. Towards the end of it, I'm going to get a little theoretical in this little session. We're going to talk about something called reification. It's something that maybe you've never thought about before, but I see it all the time in studies and it makes me laugh. So make an assumption that a researcher has 6 variables and it boils those 6 variables down into one thing. Okay. So think about those 6 variables being like size, analyst following, analyst dispersion, all of these things. And it takes those 6 things and boils it down into one factor. And then the researcher calls it information environment. Now, the problem with that is it's not really information. It's size, it's analyst following, it's analyst dispersion, right? And so even though the researcher calls it whatever, right, in this case, information environment, it doesn't mean it is information environment. But oftentimes we as researchers, just because somebody did a PCA and boiled it down into one factor and called that factor X, we kind of treat it like it's X, when in fact it's not. It's the factor that represents these 3 different things that we measured, that we boiled it down to X. And so that's what we call reification. It's discussed a lot in the social sciences. Until we wrote this paper, I don't remember seeing one reference to reification in accounting. In other words, it was something that other social sciences talk about when they use PCA and factor analysis, but before our paper, I never saw a mention to it. But it's something that we need to think about, right? If a researcher does some statistics and takes 6 things and boils it down to one and calls it Snoopy, Snoopy is a cartoon character in the US. I don't know who Snoopy is, but calls it Snoopy. We need to be aware that it's not really Snoopy. It's 6 different things that made Snoopy. Okay, I should have used Mickey Mouse as an example. Mickey Mouse is far more famous than poor Snoopy. All right, so yeah, I've already said it. A general lack of theory and disclosure. Great. All right, so let's talk about oftentimes why PCA gets used. Oftentimes, principal components is used because people are worried about multicollinearity. And what that means is, hey, I've got these 6 variables, and these 6 variables all measure kind of the same thing. And if I put these 6 variables into one regression, I'm going to have multicollinearity issues. That's if you've read enough studies, you kind of know that's what people usually say when they're running regressions and they do a PCA. Now, I agree. I think this is actually okay. It's okay to say there's nothing wrong with saying it. But we have to remember that PCA can alleviate multicollinearity issues, but it's really not the default option. It's not the best way to deal with multicollinearity. So be careful if you're using PCA just to worry about multicollinearity. There's probably other better ways to make your regression better, whereas PCA is really used for something completely different. PCA is used if you have multiple measures of the same thing or same things, and you want to take the data and bring it down to a smaller number of components. That's the purpose of PCA. So that's my comment about PCA to fix multicollinearity. I understand what you're doing. It makes some sense. I'm not saying it doesn't, but there are other methods to handle multicollinearity that we might want to consider instead. All right. So let's talk about accounting research. So it is very, very common for researchers wanting to kind of measure a firm's information environment. Okay, how good is the firm's information environment? And so there's a lot of different proxies. Let me grab my pen again. There are a lot of different measures that I've seen and we as researchers have seen for proxies for information, like how big is the firm? The theory being the bigger the firm, the better the information environment. How many segments does the company have? The theory being the more segments they have, the more complex they are, potentially the more complex they are, the less information, so the worse the information environments. Alternatively, the more business segments that a company reports, maybe that's a better information environment because I get more detail on the firm. You could kind of go both ways with that. Analyst following, the more analysts we have following the firm, in theory, the more analysts are ferreting out about that company. So in theory, the more analysts, the higher the information environment, the better the information environment. And then market to book, who knows? Market to book measures growth. Growth can be all sorts of things. Market to book also can measure other things, overpricing. It can be measured a lot of things. So that's kind of the point in us doing this. We see a lot of people using market to book to measure the information environment. Well, how should that correlate with what we think is the information environment? So what we're basically going to do then is say, okay, we don't really know how many factors and a firm's information environment has, but we do know there's a lot of different variables to measure a firm's information environment. And so what we might think about doing is exploring a firm's information environment based on a bunch of different variables that we've seen used in research to account for, I guess, since I'm an accounting professor, account for a firm's information environment. So that's kind of what we're doing, okay? Now, we are going to use an exploratory factor analysis instead of a confirmatory factor analysis. As a matter of fact, our study really doesn't really talk about CFA very much because it turns out CFA isn't really used very much in accounting. And the idea between CFA, the C there stands for confirmatory factor analysis, is I would already have an idea of how size, business segment, analyst following, market book relate to the underlying factors and how many factors there are. And then I would basically use the data to confirm that this is how it works. Well, because we as social sciences in accounting haven't really gone there to confirm our theories. And again, I got to be careful. There are a lot of good studies in behavioral research that basically, for example, ask a survey of people and they think, okay, on this survey, these 3 questions should be this factor, and these 5 questions should be that factor. Right? Again, I'm not saying confirmatory factor analysis doesn't exist in accounting. Of course, it does. But it's used far less than exploratory factor analysis or principal components analysis. So our study focuses instead on exploratory factor analysis. So first, before you ever run a factor analysis, you need to say, is the data okay to do this? The first thing would be the KMO statistic. This one's pretty easy to think about. A value of 0 suggests that basically the variables we're using aren't correlated. If they're not correlated, then we can't do this. This is all measuring different correlations within variables and across variables, across different factors. And so a KMO is very similar to a Bartlett's test of sphericity, which also tests the presence of correlations among those measures. And so most researchers just skip this. They just say, okay, I'm going to assume my data is correlated, which in social science is probably true, right? Most data tends to be correlated with each other. But what we noticed in accounting is we as a discipline don't report the KMO statistics or the Bartlett's test of sphericity to essentially test whether or not we should be doing a PCA or a factor analysis in this case. Okay. In addition to doing this, we might think about, like, once we run the factor analysis, how many different factors are there? Now, this is a really hard thing. Again, some of you are like, oh, I took a statistics one time and I'm just going to, any eigenvalue greater than 1. Okay. If you don't know what an eigenvalue is, I'll show you one later. But basically, statistically, it shows that the correlation amongst the variables is high enough such that this is one factor and can be set apart in explaining the variance. And if you think about like all data being like explained variance and unexplained variance, here's one factor that really explains the variance among these different things. Okay, that's what an eigenvalue is. Okay, and so one thing is something called the Kaiser criterion, which is any eigenvalue above 1. Great, that's a factor, okay, and when we do an exploratory factor analysis. Another way of doing this is, hey, what we're going to do is we're going to just see how much of the data we can explain in terms of, maximizing the variance explained. Once we get a majority of the variance of the data explained, so 60, I don't know why, but 60% tends to be the number. I didn't make it up. Somebody else did a long time ago. But once we have 60% of the data explained, that should be enough, okay? And then finally, my favorite is the hockey stick test. I don't know how much Indonesians play hockey, but if you do play hockey, you know that a hockey stick looks something like that, okay? A hockey stick looks something like that. If not, basically what we're looking for is a breaking point at which the variance that we're explaining, that the next factor that we add essentially stops explaining more data, right? That's what we're trying to look at. At what point does that next factor we add not add a lot, essentially, to explaining our data? So using this, we're going to basically try to figure out what these ad hoc methods are. So take a look at this data. So this is what I told you we're going to do. What we're doing is we're trying to look at this idea of information environment. We take all of these variables: firm size, market to book, litigation risk, firm complexity. We take all of these variables. Where is my there it is, my pen. All right. Firm size, market to book, litigation risk, firm complexity, stock volatility, earnings volatility, discretionary accruals, analyst accuracy, analyst dispersion, number of analysts following the firm. All of these are proxies in accounting for how good is the information environment. And we're going to run them through an exploratory factor analysis, and we're going to see, based on these criteria we just talked about, how many factors we should have. Well, here's the problem. You're about to see the problem right in your face. Okay, this is relatively ad hoc. Why is this ad hoc? Well, what if we have an eigenvalue on one case of 1.02 and the other one is 0.98? Well, again, using the Kaiser criterion, any eigenvalue greater than 1 is a factor. Anything less than 1 wouldn't be a factor. Now look at this. here we have our different factors. And if we look, here's our eigenvalues. We've got 1, 2, 3. But our fourth, oh man, our fourth eigenvalue is essentially 0.99 if we do some rounding. That's about as close to 1 as we can get, right? So should that fourth factor be a factor? Well, under the Kaiser criterion, no, because it's less than 1, so who cares? But again, if this factor would have been 1.0001, then we would have said, yes, it's a factor. And so you can see here's the problem in doing exploratory factor analysis. At some point, we have to say, this is the criteria I'm going to use. Okay, so let's use the percentage of explained variance. Factor number 1 explains, where am I at? Here we go. Factor number 1. Here it is. All right. Factor number 1 explains about 22% of the variance. The next factor explains about 19% for a cumulative of 41%. And then the third factor explains 12.96% for a cumulative total of 54. Well, if we were using the 60% explained test, you can see 60% explained test, you can see that we would actually need a fourth factor to get us to 64%. And so just like it looked like we probably should have this as another factor, it looks like under the 60% rule, we certainly should. And then finally, the scree test. This is my favorite one because it's just eyeballing stuff, okay? Once again, we look here for an inflection point, and so a hockey stick. So we've got a hockey stick, right? And so it looks like, once again, we'd want 4 factors. But if we use the Kaiser criterion, we'd only have 3 factors. So this is where it ends up being pretty interesting in terms of, okay, what do we do as researchers here in terms of identifying how many factors? Now, stop for a second. Let's just assume that the researchers see this beautiful table, see this slide that sits in front of you. Imagine that the researchers didn't show this to you. This is what happens in accounting research. Is somebody out there says, hey, we ran a factor analysis and we have 3 factors because we chose all of the eigenvalues above 1. We use the Kaiser criterion. Now, as a researcher, you don't know that there's another factor out there that is essentially 1. You don't know that the percentage of variance explained is under 60%. And you don't know that using the scree test, we probably should have 4 factors. Rather, what you're given is just what the researcher wants you to have. And so that is what we're saying in our paper is the problem, is if we don't report this stuff in an appendix somewhere or in a footnote somewhere, right? If we don't report this stuff, then what are we doing, right? We are essentially deciding as the authors of the study that we know better than anybody else, that we know what the data looks like. And that might be true. Authors might know best relative to everybody else. But as a reviewer, I would like to see this information. As a reader of a paper, I would like to see the assumptions that are happening to understand why somebody might, when they're trying to measure information environment, I guess I had too many slides back, but when you're trying to measure information environment, why might you want more than 3 factors to measure the firm's information environment? That's an example of use of factor analysis for firm's information environment, as well as the problems associated with doing that, okay? Now, given that the decision to retain a certain number of factors is likely meaningful for the rest of your research, we ask that researchers explicitly disclose to their readers what procedure they used, what was their criterion for selecting, hey, we used the Kaiser criterion. Under the Kaiser criterion, we're using eigenvalues above 1, that's our thing. But by the way, there's a 4th factor that's really close here. And by the way, when we use that 4th factor, here's the effect on the results. Assuming that we didn't use that Kaiser criterion, how does our paper change? That's what we're asking for in our study. Okay, providing evidence whether or not the main results are robust if you use a different criterion. Okay. All right, what about factor rotation? I'm going to be pretty quick about this. Our paper does a really nice job of talking about factor rotation and what you might think about. But basically, this is the way that I would teach this simply, is that if you're going to rotate the data, which you probably should, you probably want to use oblique rotation, because oblique rotation is often used in social sciences. And the nice thing about an oblique rotation is it allows for correlation among the different components or the factors, right? So if you're doing the PCA and you have factor 1, factor 2, factor 3, or if you're doing the EFA and you have factor 1, factor 2, or factor 3, or if you're doing the PCA and you have component 1, component 2, component 3, an oblique rotation allows for correlations among the different factors and among the different components. Okay. Now, it turns out among the oblique rotations, the most common is a pro-max rotation. And so that's something to consider if you're going to do a PCA or a factor analysis. Probably want to rotate the data using oblique rotation, and you probably want to use Promax. Again, our paper provides some statistics about what happens if you use orthogonal versus oblique and different types of rotations. You can read it for that purpose. Now, I told you I was going to go through more data here. I have plenty of data to show you. It turns out what we basically did is we said, all right, we're going to look at these top journals. Why did we use these journals? Because literally we went to Google Scholar and we said, what are the top accounting journals? And here they were. Okay. And so we went to these top journals. And by the way, we wanted to make sure that we had a tax journal. We had a journal of management accounting research. We had an auditing journal. Okay. We wanted to make sure that all the different disciplines within accounting that do archival methods were covered here. And so what we did is we went through and we looked from 2015 to 2019 using keyword search to try to see whether or not people were doing principal components or factor analysis. And of the articles published during those years, we find 219 articles that were either using a PCA or a factor analysis. And as you can see, it seems like we're using it more and more, a little bit, over time. And as you can see, all journals, especially the Accounting Review, seem to have a lot of use of PCA or factor analysis. Most of the studies were archival studies, and as you can see, a lot of them were financial or managerial related. Okay. In terms of how important was PCA or FA, I already mentioned this before, 36% of these studies, it was a variable of interest, and 12% of the studies, it was the dependent variable. So in other words, an important variable for the analysis, important to the takeaways from the studies. So what our paper then does is we present two programs in SAS, and then in the appendix we use Stata to basically try to look at how to deal with the complexity of measuring a firm's information environment. Okay, and that's kind of what we do. We demonstrate the different decision points. What about rotations? What about test of reliability? What about retaining components and factors? Just like I kind of already walked you through today. That's what the study does. Please read it. Please share it. Please use it for your future research. Now, remember that PCA and factor analysis, they're designed to achieve different goals. And so the researcher's choice between using one or the other should not depend on what the researcher wants to do, but rather it should depend on the nature of the observed variables and what needs to be done there. Not, hey, I don't want 10 things, I want one thing, so I'm going to do a PCA to make it one thing. That's not good accounting research. That's not good research at all. Rather, you look at the 10 things and say, okay, based on these 10 things, are they 10 things measuring the same thing? If they are, I can do PCA. If they're 10 things measuring different things, I'm probably going to have to do a factor analysis, an exploratory factor analysis to see what does the data show me on how these things are correlated with each other. Now, it turns out in our study, in addition to looking at, as we said here, in addition to looking at information environment, we do another analysis using PCA that looks at stock liquidity. It turns out we in accounting and finance have a ton of measures about stock volatility. Stock liquidity is just a thing, one thing, and we have a bunch of different measures. And so we show how PCA might be used appropriately to take a lot of different measures of stock liquidity and boil it down into one component or two components, depending on what the data shows. Okay. All right. Let's see. Yeah, I've already said that. I've already said that. All right. So studies should disclose the research design choices. I've already said this. Please, 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 whatever your extracting technique is, disclose it. Whatever your factor retention criteria were, disclose it. Whatever rotation technique that you used, disclose it. Okay. Studies that then do this should tabulate the descriptive statistics and provide this in an appendix somewhere. In addition, we need to see the eigenvalues, the respective factor loadings. That's what tells us whether or not you did a good job with your PCA and your factor analysis. So, as I said, I wanted to talk a little bit about reification. Reification is something, again, that we just don't discuss in our literature, and we probably should. If you do a principal components analysis and you end up with one factor and you call it something, after you attach a name to it, it's really easy to forget that it's not really liquidity. It's 10 different measures of liquidity. Okay. And so we have to be very, very careful when we name things and when we read papers, when authors name things, that we pay close attention to the fact that just because a researcher calls it X doesn't necessarily mean that it's X. Okay. The PCA might have discovered the underlying correlation between all these things that measure the thing that the researchers are saying, and it could also identify a different correlation measuring a completely different thing that the researchers called X, but it's actually Y. Okay, we have to really be careful of this. And so I think this is, again, I'm a bit of a nerd when it comes to statistics, but this is one of my favorite things to talk about. So here, Klein describes 3 cautions regarding component or factor names. He said, A, they are solely for the use of verbal communication and may not actually mean that the hypothetical construct that is correctly labeled. Okay. Now, B, they should not be thought of as corresponding to real things. Okay. It's just it's a correlation structure amongst a bunch of variables. Okay. It's not a real thing. It's not the thing we say it is. But my favorite part is C. It should not be assumed that if they have the same name, that 2 components or factors are the same thing, the jingle fallacy, or that if they have different names, they are actually different things, the jangle fallacy. I don't know how this Klein came up with this, but jingle jangle is just the funniest thing I've ever heard when it comes to statistics, just because 2 things have the same names. So imagine 2 papers, both do principal components analysis, and they both call their variables the same name. If they use different variables to come up with that PCA, just because they have the same name doesn't mean they're the same thing. That's the jingle fallacy, right? And just because one researcher takes 5 factors and boils it into X, and another researcher takes the 5 same factors and boils it into Y, one called it X and one called it Y, and so you think they're different, but they might be the same thing because they have the same components. That's the jangle fallacy. Just to me, I find that hilarious. I think it's pretty funny. So, recommendations for the future. First of all, it is extremely difficult to confirm the validity or accuracy of a PCA. So please, 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 when somebody runs a PCA, we have to be careful to make sure as a researcher that we agree with the methods that they're using, because accuracy and validity just doesn't really work with correlation structure type measures. Okay. PCA is a black box. We have to be comfortable with its use, and we're going to have to accept the results that it is. Now, one significant drawback of using a PCA and FA is that it's really hard to understand interpretable magnitudes. So let's say, again, we're using a PCA to take liquidity, stock liquidity, and boil it down into one thing. Well, if we have one measure of liquidity, let's say bid-ask spread, we can use that in a regression, and any effect, we can kind of calculate the effect of bid-ask spread on whatever we're looking at, right? However, if we take bid-ask spread and we combine that with turnover and trading volume and all those, and put all of those things together as a principal component, we essentially can't analyze the magnitude of the changes to that thing that we created, that monster, that Frankenstein monster thing that we created. we can't analyze magnitudes. Magnitudes don't work on a PCA type analysis. Okay. And so that's a problem with it. Finally, the use of PCA in accounting research seems to be about convenience. All right, I want to do a regression, and a regression is easier done if I have one variable than if I have four. So I'm going to take these four things and put it down into one. That, when I read papers, it seems like the researchers are just trying to make things easy instead of doing things that they should be doing for real purposes, for the purposes of doing statistics properly, for the purposes of getting our regressions right, for the purposes of doing statistics as statistics should be done. And I think that's a pretty big limitation there. So in our paper, we talk about a couple examples that we've seen, especially I've seen in the accounting literature. Okay. They are competition and Hofstede's cultural dimensions. Okay. It turns out if you do any research in competition, you probably know that there are a lot of different types of competition measures. Okay. And what I mean by that is a lot of people, for example, try to take things that are different competition measures and they try to boil it down into one element of competition. So think about that for a second. Researchers over the last 20 years have shown that there are different measures for competition. Those studies are literally, the purpose of them is to show that concentration is not competition. Concentration is something different, for example. And so it's pretty funny if you think about it, if a researcher then says, okay, I need a measure for competition. I know there's this measure for concentration. I know there's this measure for concentration. I'm going to combine them. That just doesn't make any sense. We literally have research that shows that competition is multidimensional. And so the idea that somebody would take a shortcut and say, okay, I'm going to take this multidimensional construct and boil it down to one thing, that seems pretty silly, right? And so that's where we get to Hofstede's measures. I can't tell you how many papers I've ever read. Now, first of all, let me say, if you know Hofstede's measures, you know these are pretty controversial. Not many people love this, okay? People don't necessarily love that Hofstede said, okay, some cultures don't like uncertainty. Some cultures have more power distance than other cultures. Let's not even pretend to debate that tonight. Okay. I don't care if you like it or if you don't like it. I don't care about that. But it's hilarious that I've seen in multiple papers that say, hey, Hofstede's has these six different measures of culture. I just want one. I just want one measure of culture. And so I'm going to take these six and boil it into one measure. What are you thinking? The purpose of this entire study is to show that people differ across cultures. And sure, your regression would be easier if you only had one measure, but the whole purpose of this line of literature is to say that people can't be boiled down into one factor. And so the idea behind this is just crazy. But I promise you, if you Google it, you'll see there's researchers out there that have done this, that have taken these six different things and said, I don't want six, I want one. One is easier to deal with, and they boil it down to one. That is bad. It is so bad because it's not doing what you're supposed to do. If we boil things down to one, they should all be one factor, right? Liquidity is one thing. Six different measures of liquidity, they can all be one thing. Readability is one thing. Flesch-Kincaid, fog, smog, those are all different measures of readability. Those can be one thing. But trying to take six separate things and boil it down to one thing is, first of all, insane. And secondly, really bad research. And so just be careful what you're doing. Be careful that you know how to do this properly, okay? Before you start running statistics, think about the theory behind the thing you're measuring. Is the theoretical construct that you're measuring one thing? Okay, then take a bunch of measures and boil it down to one thing. If the theoretical construct is multiple things, you should probably have multiple measures of that thing. Okay, that's more of a factor analysis stuff. Anyways, all right, I'm done with that. But again, this is No, this is surprising stuff to me. We provide analysis in our study to show essentially that SAS and Stata, interestingly enough, don't get the same results. So we found this somewhat fascinating, that if a researcher chooses to use Stata versus SAS, you'd think that the code underlying these two programs is identical, but it turns out it isn't. And so one thing that you might need to understand is that if you run code in SAS and code in Stata, sometimes you might not even get the same results with the same data set, which we observed in our Stata, which was, let's just put it this way. We emailed the UCLA, the University of California at Los Angeles folks in statistics, because if you've seen, they have one of the best web pages. If I can give any advice tonight, if you ever need any statistical advice, UCLA webpage is fantastic for statistical advice. And so we emailed these experts and we said, listen, we're just accounting researchers. We don't understand what's under the hood of SAS and Stata. What's going on here? And the UCLA people were like, I don't know. We don't know why these get different results. And so we found it pretty fascinating that using SAS versus Stata affected our results. All right, so that's kind of what I wanted to share tonight with respect to PCA versus factor analysis. Now, because I do a lot of research, I wanted to show you an example of how I've done this in one of my recent research papers, okay? And so I'm going to switch over for a second, but before I switch over, does anybody have any questions about any of the stuff before I switch slides? Any questions about what I've discovered? Any questions about what I've presented tonight so far? Yeah, I have a hand up. Ratu.
Yeah.
Hi.
Hello, Prof. Kris. I still there is something I still don't get when it comes to PCA and FA. Like how do PCA and FA compare with other multivariate analysis method like such as regression analysis, cluster analysis, and structural equation modeling in the context of accounting research. And additionally, I'm curious about the capability of PCA and FA to address nonlinear relationship in nonlinear relationship, because in my recent study on which determinant, I identified non-linear relationship between variable such as age and tenure, with which prompting me to square these variables in panel regression analysis. However, during the PCA and FA analysis, I did not perform any transformation on this variable. Subsequently, after obtaining prediction and factor from PCA and FA, I utilized them as determinant affecting wage in panel regression. Despite the absence of variable transformation in PCA and FA, the result from this analysis in predicting factor influencing wage exhibited similar p-value compared to the panel regression outcomes, although with a slightly lower RSQ value. So I'm puzzled by the fact that in PCA or FA, there was no need to transform variable like squaring them. Could you please provide insight into why this difference exists and how PCA and FA handle nonlinear relationship without requiring variable transformation?
Yeah, great question. I actually thanks for asking this. I don't know very much about nonlinearities in PCA and FA, and so let me first say that is not something that we did anything on our paper about, and so that's an interesting question. I find that interesting. Now I can give you some intuition behind it, right? Again, this idea behind it. Now, if you think about like these variables, what PCA and FA are doing, right? They're basically looking at the relationship between variables, and sometimes the relationship between variables might help adjust for any nonlinearities in the data, right? So again, the way that a variable X might be related to variable Y, the correlation between those might help adjust for any nonlinearities. Think about square terms or, whatever, cube terms or those sorts of things, right? And so I can see why it might be helpful, because basically what it's doing is it's taking the higher dimension data and it's breaking it down into lower dimensions. And sometimes those lower dimensions might be helpful and more helpful than the underlying data because the correlation structure tells you something. Now, I would say that in your case, it seems to have worked. I would definitely say that it wouldn't work in every case, right? And so, once again, as a non-expert in nonlinearity, it's not something I do a lot of research on. And I should have said this at the start. Um, I wouldn't consider myself an expert in statistical methods. Again, I'm an accounting research professor. Even worse, I'm an old accounting research professor, right? And so the statistics that I learned in my classes, whew, that was a long time ago, right? But I can understanding again what PC and FRA are doing. I can understand how it could be helpful in trying to deal with nonlinearities, because basically it's taking the data and transforming it into correlation structures as opposed to the original variables themselves. And to the extent that those correlations, right, are able to break down the nonlinearities, I could see how it would work, but I wouldn't think that it would work under every case. Is that helpful?
Yes.
Okay.
Thank you,
Okay.
Prof.
I hope
Chris.
that's helpful. Anyways, but great question. It sounds like you're doing interesting stuff. That's great. That's fantastic. Any other questions before we move on to my research project? All right. Well, I'm going to go ahead and move on to my research project then, since I'm running out of time a little bit. It's already 10:05 p.m. here, so I have a few more minutes left. All right. So I need to switch PowerPoint slides. There we go. And I need to do that. All right. Can everybody see my new PowerPoint presentation? Everybody okay with this? All right. So this is a brand new paper. This is a paper we just started. We just submitted to review for the first time, actually about a month ago. This is me. Hi, nice to meet you. I'm Kris. Bok Baek is a professor at Seoul National University in Korea. Alex Kim is a PhD student at Chicago University. And Chun-Suk Lee we're excited about this. He was a master's student, like some of you out there, and he just applied to a PhD program, and Chun-Suk just accepted a PhD. He's going to go be a PhD student at Stanford University, so a great university. And so this is with Bok Baek, Alex Kim, and Chun-Suk Lee. And basically the idea behind this project is whether or not auditors pay attention to managers' need to beat earnings targets. And so the earnings target we're going to focus on here is the zero earnings target. So if you've done research before, you know that managers want to report a profit and not a loss. That's the idea behind it. Now, you probably know that auditors also audit financial statements. And so before our study and before some of Lennox's study, so Clive Lennox has data in China, this is data in Korea, we often didn't know whether or not auditors affected firms' ability to beat or not beat earnings. And so that's what we're kind of looking at is, does the auditor seem to pay attention to whether or not a company is going to meet or beat their expectations, in this case, zero earnings, around a benchmark, right? That's all we're interested in. Now, what does that have to do with PCA? Well, we're particularly interested in whether or not auditors that have economic bonds with their client. So again, think about a firm, just firm X has no ties at all to its auditor. The auditor is going to come in and make a decision whether or not to make that company go down below earnings, right? So below zero, right? We're basically interested in whether or not an auditor that is bonded with their client will make a different decision. Okay, that's all we're interested in. So we use as our different measures of bonding non-audit service fees. The idea behind it is an auditor that has a bunch of other business with the company likely has a weaker audit. They're likely worried about making the client upset because they're not going to get all those non-audit fees. That's the idea behind that. Okay. Auditor tenure, the longer that somebody's been auditing us, the better the relationship. The longer the relationship, the less likely they're going to make us do things we don't want to do. And then the last one is the opposite of this. In Korea, if you've done some bad accounting in the past, the Korean government mandates your auditor. So there is no relationship there. They tell you who your auditor has to be. And so our hypothesis is that Here's the effect. You can see that it appears that auditors don't seem to apply the same stringency to audits around this period. In our hypothesis, it would be even worse here, and much better here when you're mandated an auditor. So that's the idea behind it. Okay, go read our paper. I like it. I think it's cute. But what does this have to do with PCA? Well, it turns out in the methodology section here, what we do is we have these, here we go, these three different measures of bonding. We have a measure of non-audit fee, we have a measure of tenure, and we have a measure of mandatory. And it probably behooves us to create one measure, which we call the bond. Now, again, this is what we say is a perfect ideal situation for principal components. All three of these things are just supposed to measure the same thing. How tight is the bond between the client and the auditor? We just have three different measures: audit fee, tenure, and mandatory. And so if you read our study, we do what I said we should do. We show you the different loadings. These are the factor loadings. We show you the eigenvalue on this thing, and we show you the Kaiser measure of sampling adequacy, whether or not we should be doing this, okay? And so this is our test to see whether or not auditors who are bonded are less likely to require audit adjustments that would cause a client to go below zero earnings, okay? And sure enough, when we run our results, what happens is when we combine these three things okay, we see that non-audit service fees, that companies that have high bonds are less likely to have a adjustment that brings them below a one bin down. We call it a one bin down audit adjustment. One bin down right there. We see that companies that have a longer tenure with their auditor are less likely to be required by their auditor to go one bin down when that one bin down will cause them to have a loss. We show that auditors that are mandatorily assigned, you're assigned to this, are less likely to go one bin down, as you can see. Are less likely to go one. But if you're mandatorily assigned, you're more likely to you're more likely to be required to do this. And sure enough, as you can see here, our CBI, which is the joint measure between these three things, is loading as we suggested it should load, such that the higher your economic bonds, the less likely your auditor is going to require that adjustment. Anyways, that's our study. We think it's pretty interesting, but this is an example of how you might rightly use a principal component analysis, and more specifically, how you might be required to, where is it at? It's here somewhere. I'm going the wrong direction. All right. You might need to disclose, hey, what are our factor loadings here? What are our eigenvalues? What are our Kaiser measure of sampling adequacy? Okay. I just wanted to share with you a brief example of how I've used PCA relatively simply in a recent research study that I submitted for review with some colleagues. Okay. I apologize for going so quickly through this again. I think it's a pretty interesting study, but it's not that I want to present the study itself, although I do because I love my research, but I wanted to show you how you can use a PCA in an accounting research study appropriately to take three different measures of bonding and narrow it down to one measure of bonding, which, by the way, we use. Why is that helpful? Later on, we try to measure whether or not, there it is. We try to measure whether or not firms that have incentives to meet or beat earnings, the results are higher or lower, right, with firms that have high economic bonding. Now, think about this table here. On this table, this is a firm's incentive to meet or beat earnings, right? And this right here is bonding. Now, if we had three different measures, we'd have to have panel A, panel B, and panel C using non-audit fees. We'd have to have another one using audit tenure. We'd have to have another one. The benefit of doing this is if I have a CBI, I can just use my CBI for one table looking at how, go back up, love all these slides, sorry. There we go. Bonding and incentives together affect the relationship. So I just have one measure of bonding, and then I can look at the individual incentive measures. It's way easier to do this than do one table with 3 panels, and all 3 of those things have different measures of bonding, right? That's the idea behind having a principal components and one factor. And it's the number one reason why researchers want one factor instead of 3, is later on, if you have interactions, you want to be able to do those interactions with one thing instead of 3 things. Now, pause for a second. We didn't do it this way because we want a simpler analysis. We did it this way because these are just 3 measures of one thing. And so it can be done that way. It's not that we wanted it easy, but because all 3 things in our minds measure one thing, that's why we could do a PCA here, okay? If they were 3 different things measuring 3 different things, we can't do this. We have to have 3 different panels, okay? But because we think they are one thing, that's what we did here. So in conclusion, in our study, we basically document that auditors seem to not want to adjust their clients below 0, especially when they're economically bonded. That's the idea behind it. Especially when there's an economic bonding there, auditors don't seem to be as independent as we'd like them to be. Okay, I think it's a cool paper. We can only do this because we have really cool Korean data. Most of you probably know you don't really get financial statements before the audit. You only get them after the audit, right? But in this case, the KICPA gave Professor Bachbeck access to the data that they have before the audit and after the audit, and we're able to compare what does the earnings, what is the net income, in this case, profit versus loss. Is there a profit before the audit? Is there a profit after the audit? We can test this hypothesis, which we think is kind of cool. All right. So thanks for allowing me to share quickly one of my studies on this, looking at audit adjustments around financial benchmarks. It's been fun sharing the evening with you. It is about what time is it now? 10:15 here. Any questions that you have for me? I know we've done this for about 75 minutes. That's probably pretty long for all of you to look at me on Zoom and hear me on Zoom. Any questions that you have for me about anything I shared?
Yes, anyone? Or maybe I just pose my question first. Yeah. Okay, thank you, Kris. I would like to ask about the factor analysis. Yeah, factor analysis versus theory. Okay, for instance, if based on the theory or framework, we know that there are 5 factors with each components. So it should be classified into 5 factors. But then using the factor analysis as the statistical method, the statistical results classify component A into factor B, for example. While based on the theory, it should be in factor C. So how can we deal with it? Should we follow the theory or should we just follow the statistical method results?
So I love it. That's a great question. So first of all, interestingly enough, it appears that this is a confirmatory factor analysis. In other words, we know what the factors are, and we know that, this variable, this measurement, whatever I measured on this thing, should be associated with A, but it's actually associated with B. In that particular case, it suggests that our instrument, whatever that variable that is that we're measuring, might have one of 2 things. Either our theory is wrong or the thing that we use to test the theory is wrong. Okay. And so the research on CFA would suggest that maybe you just have a really noisy proxy for factor A or factor B or whatever, right? And so my recommendation to a researcher that was facing that was go back and look at the question that you asked or the variable that you're looking at and make sure that something isn't wrong with the way that you measured it. Something's wrong with the question that you asked on a survey or whatever, because that's probably more likely true than the theory isn't right. Now, that doesn't mean that theory is always correct. Of course, theory sometimes isn't correct. But unfortunately, in that particular case, what it might suggest is that CFA isn't appropriate because whatever your theory is, it doesn't seem to apply to the data very well. So in that case, you might not do a confirmatory factor analysis. Instead, you would do an exploratory factor analysis and say, okay, based on these questions, what factors pop out of here? And maybe it's 4, maybe it's 5, like you said. And in that case, the data would tell us what the factors would be, and then our job would be to label those factors, right? Not based on theory, but based on observations, right? Now, that's hard. That's a hard situation to be in because if you're going to try to publish that paper, in theory, you had the theory based on prior papers, and so your paper would essentially be trying to down prior theory based on some survey or whatever you did. That's a pretty tough situation to be in. But that would be my guidance, right? Is if the factors don't load based on the theory, I would first check like my measurements, check that the questions that I asked on a survey or check the variables that I measured based on financial statements or whatever it is, and just make sure there's not something wrong there. If that's not the case, probably CFA isn't appropriate here. I shouldn't be confirming theory. I should be exploring theory with an exploratory factor analysis. Is that helpful?
Yes, of course.
Yeah, awesome.
Yeah,
Any other questions out there before I put my head to the pillow tonight? Although, as you can see, I'm still in my office, so I still got to drive home and get to my pillow. But any other questions for me? Oh, by the way, I did happen to see. Let me take a quick aside. Did you guys have Joe Schrader there a few days ago?
Yeah, yesterday.
That's so great. So Joe was a PhD student at Michigan State when I was a faculty member there. So he posted on Facebook that he was visiting you guys, and I said, "That's crazy. I'm visiting too, but via Zoom in a couple hours." But that's
maybe
really
next time you can visit us here.
Oh, that would be awesome. I've never been to Jakarta before. I've heard amazing things. So I've actually Joe posted on social media how amazing, how friendly everybody was and how beautiful it was there. And so it sounds like a pretty nice place to be. So anyways, but yeah, I thought I'd throw that out. I thought it was pretty interesting that Joe and Joe is a PhD student at Michigan State and I was a faculty member there. Joe and I have some papers together, and I thought it was pretty funny that back to back, you guys are going to have us as whatever presenting research essentially. So,
yeah, his research is also about auditing, right?
Is it? Yeah, that's right. I don't do a lot. My research is financial accounting. That paper that you saw earlier, that's not really an auditing paper. That's more of a financial accounting paper. But yeah, I tend to do research on conference calls and textual analysis and those sorts of things. But that's fantastic. Well, good. Any other questions before me? As I said, before I leave you, to the rest of your morning.
Oh yeah, that's from the chat.
Okay,
Yeah,
great.
I have a question. Hello?
Yeah, go ahead. Sorry.
Yeah,
I see it.
I'm interested about your new journal about the audit judgment. So I saw from sample of data you put from Korean public firms, right?
Yeah,
From
that's right. So these are
2014.
yeah, that's right. These are Korean firms. Yep.
Yeah, so means this can be expand to Indonesian's public firms then.
I would hope so. I think
method.
so. I think the economies are both similar enough that they could probably be extrapolated. Yep.
Okay, thank you.
Yeah, no problem. It looks like I have a question on the chat I wanted to answer. I would like to ask about Verimax versus Promax rotation. When should we use that? My recommendation is to use as you'll read it in the paper, again, this is something I said in the paper, but my recommendation would be to rotate your data. It makes it more interpretable. It's easier to understand if you rotate your data. And because you probably want when you think about it, you can either do orthogonal rotation. So I can go back to my PowerPoint slide here. I don't know if that helps or not, but let me kind of go to my PowerPoint here. Oh, you guys can't see this. I'm not sharing it. Okay, anyways. So it turns out when we're thinking about, you can either do an orthogonal rotation or an oblique rotation. Because oblique rotations allow correlation amongst the components or the factors, I would use an oblique rotation. And again, basically what we say in the paper, we're accounting professors. We don't code the stats or this data, but the most common oblique rotation that we saw used was Promax. And so we just said, if you want to use the one that everybody else is using, and it's an oblique rotation, use oblique Promax. That's what we say. So thank you for asking that question. Great question. But again, please, I only had a few minutes tonight to share my paper. The best way to digest the paper is to go read the paper, because the paper has the data. And so you literally can use SAS and Stata and run our programs and just see what it's doing to the data. I think that's the beauty of our paper, is when the journal asked us to do this, it asked us to provide a real world example. And so you'll see we have the data on information environment, and you can play around with that data because we sanitized it. Again, it's not our data, it's data, but we were able to sanitize that data and be able to share it with you so you can use it to try and practice this, to see what does an orthogonal versus a oblique rotation do, what does a Promax rotation versus a different type of rotation like Verimax, like what does that do to the data? Okay, so great question. Thanks for asking. Any other questions? We have about 6 minutes left if we want to use them. If not, it's okay. I understand. I promise I won't be offended.
One more question. Is it okay?
Yeah, of course.
For your paper on audit, how did you come up with the CBI factor? Because sorry, maybe I missed it in your paper, but how can you come up with the 3 factors or components to make up the CBI? Because this is also important for our students, because our students have to defend against the reviewers, right?
That's right. Yeah. It's a great question. All right. So basically the answer is pretty simply, we read the literature, right? So in the research, so let's go back a little bit. Let's go to a giant accounting fraud in the United States. Okay, let's go to Enron. If you guys know anything about Enron's one of the biggest frauds of all time in the United States. Why in the world did Arthur Andersen not do a better job of auditing Enron, right? And if you look at some of the reasons behind it, Arthur Andersen was making X amount of dollars auditing Enron, and they were making 100X doing consulting for Enron, right? And so think about it, right? If you're an auditor and you're supposed to be independent of somebody else, right? You shouldn't be making 100 times your audit fees doing consulting for that. That makes you not independent on your audit. And so if you know this, when Arthur Andersen fell in the United States, we had a bunch of regulations called Sarbanes-Oxley come through. Basically, SOX is what we call it. Okay. Yeah. And Sarbanes-Oxley changed auditing forever. And one of the things that it changed was, if you audit a company, you can't do a bunch of consulting for them. So that's why one of our measures is bonding in Korea, not the same country. You can do consulting for the company you audit for. And does that consulting affect your independence? Same thing with tenure. It turns out the longer that you audit somebody, the more familiar relationship, the less likely you are going to stand up to them. And so you probably know this in a lot of European countries, there's a mandated auditor rotation. Okay. In the United States, we mandate the lead partner needs to rotate every 5 years to try to break up that relationship a little bit. Okay. And so why do we then use, for our bonding index, why do we use tenure? Because that's, in theory, a good indication of how bonded we are. finally, that last one, which is kind of awesome. I don't know if they do this in Indonesia. We don't do this in the United States, but in Korea, if you have bad accounting, the punishment is the Korean regulator decides who your auditor is. And so I think that's pretty funny, right? Because in the United States, we're a pretty free economy, and regulators wouldn't normally kind of assign who your auditor is going to be. But in Korea, apparently they do. And so if you have accounting malfeasance, you will be assigned an auditor, and in theory, that auditor is completely independent because there is no relationship there. You didn't even get to choose them as your auditor. And so that's why that is kind of an inverse proxy. We use it as an inverse proxy for bonding. And so kind of going to your question, like, how do we choose those three things? Honestly, we read the literature, we looked at what happened when bad auditing happens, and we kind of came up with measures that we had. That's the other, I guess, fourth thing is you can only measure what you have, right? And so what we'd rather have is how many times does the company call the auditor, right? That would be a great example of how tight their relationship, but we don't have telephone data. We don't know that information, right? We don't know how competitive the auditor bidding process was for them to be the auditor. We don't have data on that, but we do have not audit fees. We do have length of audit tenure, and we do have whether or not the Korean government mandated it. And so again, to the master students out there and the other students that are there doing research, you read the literature, you look at things that are happening, and then you say, okay, based on all these, here are some measures of this thing I want to do. Does that help?
Yeah. Okay, thanks, Chris.
Awesome, no problem. Well, it looks like our time is up. I know we were supposed to do this for 90 minutes, so it looks like our time is up. But again, thanks for having me. This has been fun. Fun to do via Zoom. Maybe we can do it someday in person. But if not, again, I appreciate you having me to discuss my research, both the published paper on principal components and factor analysis, as well as a unpublished brand new paper that we've done on audit benchmarks, audit adjustments around financial benchmarks. So thanks for having me. I appreciate it. Nice to meet everybody out there in Zoom land.
Yes. Thank you, Chris. Yes,
Thank
brilliant.
you, Professor. Thank you, Professor Allee, for sharing your insights with us today. Okay.
Maybe we can have a photo together first.
Okay.
That's
Sure.
our answer.
Yes.
Yeah.
Online photo together.
Okay, maybe Sylvie or Brilly, please guide us for the taking picture.
Okay, I will guide. Wait. One, two, three. Okay. Okay.
Are we good?
Great.
All right.
Yes, all done. Yeah, thank you, Chris.
All
And
right.
have a
Thanks,
good-
everybody. Have a great day today.
Thank you.
Bye-bye.
Bye-bye.